Hey folks, welcome to a product review at Finominal. Today we're going to look at AI-powered ETFs trading in the US. Now, there are plenty of ETFs that provide exposure to companies that are active in the artificial intelligence space, for example, semiconductor firms. Having said that, the ETFs we're analyzing are actually using AI to select stocks. And that's, of course, the old competition, man versus machine. So in this case, we're going to look at those three ETFs from Amplify, Craft, and 1Q. Amplify is powered by IBM's Big Watson. Craft is a South Korean AI-focused company. And the 1Q Social Sentiment ETF uses AI to pick stocks that trade high on sentiment. And we're going to benchmark those to the S&P 500. So before we look at performance, let's have a quick look at the underlying portfolios. And so we do see that the number of holdings are, well, somewhat concentrated for that 1Q Social Sentiment ETF, which has the ticker BUZZ, with 76 constituents. We do see that the product from Craft, which is the ticker QRFT, is more diversified with 352 securities, right? But that's still far less than the S&P 500. So these are still, well, moderately to highly diversified portfolios. In terms of overlap with the S&P 500, we can see that Craft has a 33% overlap with the S&P 500. We can see the product from 1Q has a 32% overlap versus AIEQ has only a 7% overlap. So you can look at them in terms of tracking errors, right? AIEQ should have a lower tracking error. Now, in terms of factor exposure analysis from a holdings perspective, so this is a current portfolio, we do see that the underlying portfolios compared to the S&P 500 on these different metrics are quite dispersed. And so here we can see, for example, from a valuation perspective, they're not necessarily more expensive, except perhaps the one from BUZZ, than the S&P 500, but they're certainly different from a size perspective. From a growth perspective, they're kind of like almost similar from characteristics. They tend to be more volatile than the stocks as in the S&P 500. Versus there's not much differentiation from a quality perspective. If you want to complement this holdings-based factor exposure analysis, we can also do returns-based factor exposure analysis, where we have about, I think, close to 4 years of data. 3.9 years. And this is a little bit more interesting. So we do see that from an equity effect perspective, these at least two of those products tend to be slightly more expensive, i.e. they have negative exposure value factor, negative momentum exposure, and negative low vol exposure. But what's most interesting is actually the exposure to the stock market. And here we can see that the product from Amplify, AIEQ, and especially BUZZ have very high betas to the stock market. And we can partially explain that by the exposure to small caps, but the way to think about this is, especially with regards to BUZZ, that this is almost a levered bet on the stock market. And it's a function of the exposure to small caps, also portfolio concentration, right? But I suspect we will see later from risk perspective that that does have implications in a sense that these ETFs are more risky than the market. At least 2 out of 3 of those. Now, actually moving on to performance. So here we have the performance of those 3 ETFs and the S&P 500 over the last 4 years. We do see that actually none of them has outperformed the S&P 500. That's kind of interesting to think about. Then we can also look at those products from a risk perspective. And over here we see the return per annum versus the analyzed volatility. We can see that all 3 products are much more volatile than the S&P 500. And of course, they also have a lower return the last 4 years. And you can see especially that product from 1Q BUZZ with a volatility of, well, close to 32%, right? That's almost double the volatility of the stock market. And this kind of almost, well, completes our review of those three products. There is not much more to say. I think it's somewhat ironic that these ETFs use artificial intelligence to select stocks, right? And select stocks that outperform the market, right? And none of them have achieved that. And almost most ironic is that the product from VanEck, which is supposed to pick up the positive sentiment about stocks, has, well, from a performance perspective, completely failed to do so. Simply because the most hyped stocks and some of the best performers have been the AI related stocks like Nvidia. But for whatever reason, right, none of these, none of the AIs used by those ETFs has managed to actually identify that theme. And so that kind of like summarizes the view of those products, right? That they have not been able to use AI to have a superior stock selection process. They have not been better at managing risk because volatility was higher. And that, of course, reflects in very poor Sharpe ratios. So at the moment, it seems that AI can certainly help us in terms of finding a better recommendation on Netflix or on Amazon, but certainly not in the stock selection process. Hope that helps. Have a nice day.